Have you ever had a stock or option trading question that you couldn't quite find the Google answer to? Or maybe you just wanted somebody live, somebody real to answer this question. You didn't want some AI generated answer. Well, in this video, I'm dedicating it to your questions and I'm providing the answers. So I've reviewed all the questions I've been asked over the past several months, and I've picked the ones that I think apply to the majority of you. I'm going to break those answers down in this video just for you. So if you're ready, let's get started. And by the way, before I get into this first question, if you have a question about stock or options they'd like me to answer in a future video, please post it down in the comment section below. I'll try my best to work it into a future video. All right, so this first question here, and I probably totally get this name wrong, but Kryzik? I don't know. I'm sorry, help me out here. The question was, what happens if I get assigned and I don't have the money to buy 100 shares? This is on a video I'd done about fixing a poor man's cover call. So it's a really great question. It's actually one I get quite a bit. As you know, if you've been watching my channel for a while, one way I try and answer questions is by using real life examples. So here I'm going to show you a real life position I was in that I did what I'm going to suggest you do in this video. So remember, the scenario is you've been selling put options against a stock, but you don't actually have the cash to buy those put options. Well, what do you do if they're assigned to you? Now in this account, I did have the cash, but let's just act like I didn't because I did what I would suggest you do. So let's lay out the scenario for you here. As you see up top, I was assigned 2 of the T-Row November 17th 110 put options. And here you see the note I sent to my patrons down here on the bottom. You see overnight the T-Row November 17th 110 put options were assigned to us. So we bought 200 shares of T-Row at 110 per share. As you see here, I decided I didn't want to own these shares. So what can I do in this situation? Well, if I didn't want to own the shares, it's pretty simple. I just sell the shares. 200 shares were assigned to me at 110 per share, and I would just liquidate the position or sell the shares that I owned at whatever the market price was. So it's kind of that simple. But I do want to dig in a little bit more here. So let me share with you my response. I share with them that most likely the broker would do a margin call. That means you would either have to bring more capital into the account to satisfy the capital requirement, or the broker would liquidate the position for you. So that's usually what happens. If you do nothing, they'll liquidate the position. But they usually will give you some amount of time to make it good or to bring capital into the account or to liquidate the position yourself. So although this is something that might seem scary, especially if you're new, if you're not way over leveraged, then it really isn't that big of a deal. You just liquidate the position. And if you don't do it, well, they'll probably do it for you. All right, now let's move on to question number 2. And I apologize, I have to Google search the translation of this name, so I believe I did, and I think it was a name I'm really familiar with. But the question they asked me was, if you think there's a significant resistance at the 50 moving average line, don't you consider adding a bearish call credit spread above it to complete an iron condor, maximizing the return and collaterals? So I thought it was a great question because we all want to maximize our return, maximize the amount of cash that we're putting into our pocket, while also controlling our risk. If I believe a stock is nearing an area where it will definitely find resistance, the odds are really high, then I'm definitely game to do something like this. And let's look at what an example of that might look like. So I'm in a position right now in UPS. I've sold some cash secure put options that were assigned to me. I've then been selling covered calls against the position, and I've been collecting dividends, and I've also been selling some additional cash secure put options to help not only increase my cash, but also help fund rolling my cover call up and down as I see fit. But here you see UPS. It's a great company. As a matter of fact, my last real job, what was that? 30 years ago, was actually with UPS. I unloaded semis, and it's no joke. Those guys work really hard. So I know the company. I know it personally from 30 years ago working for them. But I don't necessarily like the chart. It's not a great looking chart. You see overall UPS isn't a downtrend, but I'm rolling this position because I've generated a lot of cash flow with UPS. I've done really well with it over the past several years. So I'm just continuing to work this position and collect cash flow. So when might I consider selling an additional bearish call credit spread against UPS? Well, we see it's in a downtrend, and definitely it got up in here around this red 200 moving average on this daily chart. I'd probably consider selling some additional bearish call credit spreads if I wanted to. Now, as I mentioned, I'm already in a covered call, and I have some cash secure put options I sold against it already. So I'd only do that if I felt comfortable adding to my upside risk. But this would actually be a pretty good candidate because it's finding strong resistance at this 200 moving average on this daily chart. As a matter of fact, if I zoom out here, he's been doing that for quite a while. Not necessarily at that moving average, but pretty close to it. So overall, if it came up this red 200 moving average, if the momentum didn't look really strong, I'd probably consider doing a bearish call credit spread, like I was asked in that question by one of my patrons. So here you see my response, and it was sure, that's definitely something that you can consider doing. I'm definitely not opposed to doing that, but in this situation, I chose not to. So they were asking about a specific trade I was in, and I chose not to, possibly because it was a very bullish looking position. But if it's a somewhat bearish or neutral looking position like UPS, and earnings are not approaching, that's another key factor. You don't want to do that through earnings if at all possible. Well, then I consider doing a bearish call credit spread on top of whatever other position I have going on. So thank you very much for your question. Let's move on to the next one. So here's a question I was asked on my video that I made several years ago about which is better, buying and selling weekly options or monthly options. And I probably need to update this video and include 0 DTE options, because that also is something that a lot of people are trading. But let's focus on the question here. So for option buying, we're going to focus on buying, which is better. And remember, when you buy an option, you generally have something working against you called theta or time decay. So you really want that thing to move pretty fast if at all possible. Now, there's a lot of things you can do with an option when you bought it to help decrease that time decay, but I'm going to answer this question from the perspective of I'm just going to buy an option. What's the best time frame? And here you see my answer, and then I'm going to share a chart with you and kind of talk through a couple scenarios. So my reply was, it depends on how long you think it'll take for the underlying to move to your expected spot. And then I always like to add on a little more time to give me a buffer just in case I missed it by a couple of days. The thing that you don't want to happen is for you to get the move right, but it takes 2 or 3 extra trading days and you miss the opportunity. So I like to add on just a little bit of buffer there. All right, let's look at an example of this. A couple of things you want to think about when you're trying to decide how long of a days to expiration option you should buy is what time frame charts are you trading on? For example, if I'm trading on a 1-minute time frame chart, I'm probably looking to do a 0 DTE option trade. And I play with some of those on my play accounts. If you're looking for like a 7-day option trade, you might consider using the 5-minute or 10-minute or maybe 15-minute chart. If you're looking at, say, a 2-week trade, you might consider using the 30-minute chart or maybe hourly chart. If you're looking for a 30-day trade, then probably the 30-minute chart or the hourly chart. You could also check out the daily chart. But let's dig into our question here using NVIDIA as an example. How long of a time frame expiration option should I buy? Now I've switched to the daily chart of NVIDIA. This is one of the most highly traded stocks right now, and it's had a pretty sharp decline over the past several weeks. Notice over the past several weeks, it's had about a 25% decline, so pretty big decline. From up here around 140 to closed out over the weekend at 112, so pretty big decline. But let's say you thought it was going to bottom out and maybe take off and retest some previous resistance. Well, what might we do? Well, now I've added a few support and resistance line here. And first of all, notice we have some diagonal resistance right in here. And notice we probably have some horizontal resistance right in here. So let's say my target for NVIDIA was that it would get back up here, what is that, around 130 per share? And let's try and estimate how long this will take. And one way I like to do it is to see how long it's been taking typically for it to make that kind of move. Does it tend to hang out for a while before it makes a move, or what does it typically tend to do? We do see that it tends to kind of hang out for a few bars, or in this case, a few days, since these are daily candlesticks, before it takes off. But once it begins to go, it goes pretty fast. So remember, we're thinking it's going to end up around 130. And now this isn't a trade I'm telling you to do. This isn't even a trade that I'm going to do. I'm already in a poor man's cover call with NVIDIA that I'm sharing here on YouTube. I'm actually sharing it with everyone on my Patreon. So if you'd like to follow my poor man's cover call that I'm in right now with NVIDIA, I'm sharing it with all my patrons, even the free members. So go ahead and sign up for that. All right, so what time frame options should we buy? And we'll say we're going to buy a call option. What time frame options should we buy if we think NVIDIA is going back up here to 130? So worst case scenario, I'm thinking it could hang out here for how many days? 1, 2, 3, 4, 5, 6, 7 days, 8 days, 9 days. So 9 days it might hang out in a little zone down here like it did back in here, and then it should take off. Then how many days does it normally take to reach its full potential? Well, we got 1, 2, 3, 4, 5, 6, 7 days. So altogether that's what, 16 days? And then we're gonna add a few days to that. So we'll just say about 20 days. That's about what, 4 weeks. So if we thought NVIDIA might end up at 130 in about 4 weeks, we want to buy a 4-week option. So that's probably what I'd buy. If I thought NVIDIA was going to make that move, then I'd buy a 30-day option. That'd give me about 20 trading days for the position to go my way. Now personally, I probably wouldn't just buy a call option. I usually like to get call options for free, and I do that by selling put options well below where the stock's trading at. That's called a risk reversal, and I have a video on that if you want to check it out. That's kind of my thinking here, is count how many days it tends to consolidate and then how long it typically tends to take to make its move. And then I like to add a little bit of time to that just in case I get the timing wrong. And of course, like always, please make sure you manage your risk properly. So know what's the worst thing that can happen to a position before you place a trade. But that's how I come up with a time frame that I buy options with. And if I want the easy route out, I just buy a longer term option. So thank you, YouTube viewer, for this question. Really important, really great question, and I hope that answers it. Any questions about it, please ask at the bottom of this video. The next question I want to answer for everyone here on YouTube is a question I was asked by one of my patrons, and it's about a bullish put credit spread that we were in. And I love the question because they're trying to assess their risk, which is very important if you want to trade options. Really, if you're going to trade anything or invest in anything, but when trading options, I think it's even a little more important. So the question was, are you using a 1-to-1 stop loss ratio for these spreads? In this instance, I was. Whatever the credit was I received, which I think in this case was $2.50 per share, then if the position got down that much, then now is my stop loss trigger. Now there's two ways you can handle that. If you're a newer trader, you might say, I'm just out. When the position is down $2.50 per share, I'm out. It's a 1-to-1 risk to reward ratio. But if you're more experienced and you understand technical analysis, you might do what I've done. I've given myself the ability to override just the 1-to-1 stop loss ratio. Now, good or bad, if you know what you're doing, it's probably a good thing. They won't all go your way. So here's my response. Since I'm a more experienced trader and I understand technical analysis, once I hit that exit loss trigger, the position is down $2.50 per share that I received that much for up front. At that point, I check my technicals. If it looks like it might be about to find support, then I have the ability to override this stop loss. Now, if it does not look like it's about to find support, then I'm out. I take the loss, I'm out, I move on. I'll win another trade. You're gonna have some losing trades. It's just a part of trading. When you hang on to these things, it turns into a huge loss. Well, it's harder to get that money back. But if you can keep your losses smaller, it enables you to win overall in the long term. So I look at technicals, and if I think it's gonna bounce, then I give myself the ability to hang in there with the trade to see if it works out. But once it looks like technicals are failing, at that point, I take the loss. Now I can't always just roll a position out and down, but I do take the loss on the initial position. So it's a great question. It's one everyone should be asking themselves. How do I manage my risk? Before you place any trade, understand how you manage your risk. The next question is also about managing risk, about stop losses. So I thought I'd tie it on to the back of that previous one. So here's the question up top. You mentioned a stop loss. Are you working with stop loss when trading options, or is it just a mental stop loss? Then the follow-up question was, is it a stop loss on the value of the option or on the stock price? I heard some recommendations to not have a stop loss when it comes to options. Are you showing stop loss management in your videos? Well, here you go. I'm showing it in this video just for you and hopefully for the benefit of everyone watching this. So there's a couple ways you could do your stop losses. The one I just mentioned in the previous example, it was a dollar stop loss. I received $2.50 up front when I did the bullish put credit spread. If the position was down that amount, at that point, I either get out or reassess technicals to see if I want to stick with it or not. But you might also do a technical stop loss. Let me show you what that might look like. Let's say, for example, we had sold a bullish put credit spread against Nvidia. Now, Nvidia's had a big decline, as you see here, and we talked about this just a minute ago in this video. But let's say that we thought it was coming to an end and the decline was over, it was about to bounce or at least find support around this 108.59 cent area. So you sold the $105 cash secure put option. When might you use a technical stop loss? Well, let me zoom out here because I want to show you why I have this white line on the chart there. And actually, I decided to switch over to the weekly chart because it's a little more clear on that weekly chart. So I drew this line because it's kind of where Nvidia closed out on Friday, but it's also an area that served as resistance for it right in here. It then came down, and I wouldn't really say it's a support. It's really just in between 2 weeks. But let's say we thought this was support. Now, I'll be honest with you, I don't think it is really good support. I think Nvidia could go lower. I could be totally wrong. I think it more or less could come down here, around this 101.55 cent area. But let's just say that we had sold the 105 put option because we thought it was at support now. So when would I realize that I'm wrong and I need to get out of this position based on technicals? Well, when I broke through the support line and the candlestick actually closed below that line, well below the line, at that point, we're wrong. It's fine to be wrong. You're gonna be wrong in trading. You won't get them all right. The only people who get them all right are the people on YouTube who show only their winning trades. That's not reality. You're gonna lose some trades. So having that stop loss based on a technical level, I really like that. And once it hits that level, just get out. Take your loss and move on. You should have plenty of other wins. But now let me show you another time frame of Nvidia. Let's see when this might be a little bit better position to get into, at least on this time frame. So now I've switched to the hourly time frame. With Nvidia, I'm trying to watch this to see when I might sell a longer term put option against Nvidia, but I want to wait for this decline to be over. So I've drawn a diagonal resistance line, as you see here on this hourly chart. Now I would use an hourly chart maybe for like a 20 to 30 day option I was looking to sell. But let's just say, when might I sell that put option? Well, when it breaks above this resistance line, at that point I might be able to say, you know what? I think the down momentum has shifted. And so I'd like to also see it find support, which we haven't done yet. I want to see it come down and retest this support. If it came down here and bounced off this and started to take off, at that point I sell a put option. Then my stop loss would be even better because I'd have a diagonal stop out and a horizontal stop out. So understand technical analysis. It lets you pick technical stop points. And that might be better than just saying, okay, when this position is down $2.50 per share, at that point I get out. So two ways to do a stop loss I've discussed here are a dollar amount, if your position is down a certain amount, whether it's options or stocks, or if it breaks through some technical support or resistance, at that point you might want to get out of the position. So here's our next question. This was asked by one of my patrons, Billy, longtime patron. So thank you, Billy, shout out to you. The question was, it was a really good question about a risk reversal, which is a position I really like, especially in stocks that are really beaten down. I think they might be about to bounce, but I want to give myself some room to be wrong and still win. So I like to play risk reversals on those type of positions. So here's Billy's question. On a risk reversal where the put is working, but the call isn't, and I'll explain that in a second. Would you ever roll the put side out to collect more premium, thus changing the original trade? So the way a risk reversal is set up is you sell a put option, you use all that cash to buy a call option. So the thinking is if the stock's going to take off, well, that call option will go up in value, make you money, the put option will go down in value, but you used it to help fund buying that call option. I got one in Pepsi that's working out really well for me right now. My response was I would definitely consider rolling that put option out and leaving the call alone if I thought it was to my advantage. Let's think about this question that Billy asked using NVIDIA. And I put the chart here on the weekly time frame. Let's say back in September we thought NVIDIA was going to go up in price. So we probably sold a put option, let's just say down here around 55. Let's say we bought a call option up here around 160. Well, since then, our 55 put hasn't really gotten in trouble because NVIDIA did go up. It's kind of trading in this range here between, what is that, 108 and 150. So it's kind of stuck in this range. So our $55 short put option is doing great. It's lost a lot of value. So we've been able to pocket a lot of that premium if we close it out. However, our call option up here around 160 or 170 is not doing too good. NVIDIA really hadn't got close to there. So it's probably not doing so hot. So Billy's question here, would I roll the put option out to collect more premium? The answer is yes. Like right here with NVIDIA, if I had sold this $55 put option and the value is pretty much almost all gone, I'd be fine rolling that out because I have lots of support between where it's at now and that $55 strike price. However, let's now switch over to another popular stock, which is Tesla. And I love Tesla. I even own one. But let's say we're in a similar position in Tesla. We had done a risk reversal, so we bought a call option, say up here around 500. Let's say we had sold a put option right here around 230, let's just say. Let's say it was about to expire. Well, our call option is probably not worth much. And the put option, let's just say because it's about to expire, it wasn't worth much either. Well, in this situation, I would not roll that put option. I'd probably go ahead and just close out the put option and wait for Tesla to kind of calm down. Because right now, it's not calm. It's throwing a tantrum. It's heading down. Now switched over to this daily chart and you see that I've actually drawn a line here because like NVIDIA, I'm also looking for an opportunity to sell some put options or to do a risk reversal in Tesla. And I'm waiting for this little temper tantrum to calm down and for it to find support. So in this case, because it's showing pretty strong weakness, I probably would not roll that put option out. I either let the one expire if I thought it was going to expire worthless, that I'd presently sold that had a nice profit, or I just buy to close the position and wait for Tesla to bottom out and then do a new risk reversal. And that's one of the cool things about risk reversals, so you can position yourself so that you could be totally wrong. You might have a totally wrong read on the market, but you still could end up winning. And that's kind of what it sounds like is happening in this position. And I've had plenty of these that worked out that way. Risk reversal is a nice way to take a shot at something you think might take off, and if it doesn't, we don't get penalized. Because conversely, if you just bought a call option, well now all of a sudden, Billy might be in trouble because he paid money for this call option and it's not working out. But since he probably used that put option to help fund the call option, this is probably actually a winning trade, even though it hasn't worked out like he hoped. And that's why I like risk reversals. We can be wrong, I've been wrong, and you still win on the trade. So thank you, Billy, for that question. I really appreciate it. Here's the next question I want to answer, and it's from one of my YouTube viewers, and I can actually say this one. It's like M. Joy Green said, thank you, M. Joy Green. I appreciate you asking the question. This is one I get asked quite a bit, so I figure I'd just answer it. It's a brief question, a brief answer. And the question was about my spreadsheets. Is that your own spreadsheet or one from your brokers? And just so y'all know, the spreadsheets I share on my YouTube videos, they're actually ones that I created years ago, and I constantly tweak them, and I do offer them for sale. It's very reasonable. You can find them on my Patreon. The link is down in the description of every video. So please, if you want to check out the spreadsheets, they're there on my Patreon. You can purchase them right there. If you have any questions about them, please feel free to ask. Once you buy the spreadsheets, I actually have a video that kind of talks you through it. So I think it's a great tool for you to use. So thank you, M. Joy Green, for the question. I really appreciate it. And I had a reminder here to show you the spreadsheet, and I forgot. I was moving on to the next question, so I thought I'd show you the spreadsheet real quick here. It just kind of gives you an easy way to access what your profit and loss was on each trade. So really nice spreadsheet, an easy way to keep track of yourself. I actually have two other ones, one that helps you see the allocation by sector. It's like that one a lot. Then also a third one tells you to keep track of how much net cash flow I've generated by selling options in my accounts. So you get all those spreadsheets if you look to buy them, and they're all on Patreon if you want to check it out. Now, next question I got is from a YouTube viewer, and it's Matt Carla, 2009. So thank you for the question. I appreciate it. And I thought it was a good one. So we'll share the answer here with everyone on YouTube. Here's the question they asked. Have you tried selling a covered call that has about a 45-day expiration, then take that premium and use that to buy like a bullish type of call debit spread, which I really like that strategy. It kind of reminds me of the risk reversal one that we just went through, but you're doing it with premium from your covered call. So if you're really bullish on a stock, maybe it's really beaten down, or you just think it has a really good opportunity to go way up in price, then use some of that premium and buy you a long-term spread. I like spreads because the one you sold, the call you sold that's higher than the one you own, that helps take care of some of that theta decay you'd experience if you just bought the call option. But I really like this strategy, and it reminds me a lot of my risk reversal strategy I just mentioned to you. So use some premium you received to buy the potential for a bigger win. Hey, I like that. So Matt, Carla, thank you for the question. I think it's a great idea. Let me know how it turns out if you did one. So let me share with you the actual risk reversal I did several months ago. So I'm going to scroll up here so you can see it. Up top, you see the actual trade, the snapshot from my broker. And then below here, you see the description I gave to my patrons. So I did a risk reversal here in CME. And notice this was on October 2nd. Let me give you a little bit of context here before I tell you about the details of this trade. So on October 2nd, the week of October 2nd, CME was trading for around $220 per share. Just kind of keep that in the back of the old noggin there, and let's talk through this trade. So CME was trading for around $220 per share back on October 2nd. We did a risk reversal in CME. I thought it had the potential to really hit up in price. So how did I structure it? Well, I sold to open the CME January 16th of 26, so the option expired over a year from that date, and I sold the 190 put. So that put option was $30 out of the money. CME is at 220 and I'm selling the 190 put. So lots of room for CME to come down and I'd still be okay on the trade. And notice up top here that I got $10.67 per share for selling that put option. So what did I spend that money on? Well, I bought myself a call option. I bought the CME, same expiration day, January of 2026. So an option that expired in about, 15 months? I bought the 250 call. Now I didn't walk away with much. I walked away with a dime, which you can't do much with a dime these days, but I did get a credit. So overall, I was happy with the position. Well, how'd that trade turn out? Well, fast forward about a month and a week to November 12th, and I actually closed the position out way early. Remember, that's the 2026 option. But let's look at the chart and see why I closed it out. So here you see the chart. We entered it back in here. We closed out kind of more over in this area in here. So the stock was up, it was like a couple percent. So let's see what happened with the trade. Here you see we closed this position out for a nice little credit of $2.50 per share. Remember we got 10 cents or a dime when we entered it. We closed out a little over a month later for a nice credit of $2.50 per share. So really safe, easy win using this risk reversal. Now I could have stuck with the position, but I decided just to go ahead and close it out. I had a nice win there in a very short period of time, so I closed it out. Now what I did with this risk reversal, which I didn't do with this trade, but I could have, because I do it on a lot of risk reversals, is I close out my risk. I buy the put option back and I pay for that by selling a call option above the 250 strike price call option I own, so kind of turn it into a spread. But I closed it out, took the risk off the table, I was happy with the return. This next question is one I get a lot about how to calculate the return of a trade. So I thought I might just show you a real brief example in case any of you have that same question. So here's an example. Let me talk this through with you. Let's say, for example, we got $2 up front for selling some put option. Okay, let's say that we had at risk $50. If you don't want to use leverage, you say, well, I sold the $50 strike price put option. Let's say that the expiration was 30 days out. And then to annualize the return, we're going to multiply it times 365 days. So you have option premium received divided by amount we have at risk, which in this case, we're going to say the $50 strike price. And some people do this using margin. Let's say that the margin requirement is only $5. Well, then you'd make that $5. Then divided by the 30 days to expiration. And to annualize it, you multiply it times 365. And if this works out for us, we achieve about a 48.66% annualized return. So that's how you annualize the return. And I'll share with you one more example, kind of using the same numbers, but say you wanted to figure out your return on margin. We take that same $2 you received in option premium, divided by the $5 that the broker was requiring you to have on margin, divided by the 30 days to expiration, or the time frame of the option you sold. To annualize it, multiply it by 365, you see, it'd be a 486% annualized return. Man, I'll take all those I can get. That's how you calculate your annualized return when you sell option premium. The next question I want to answer for you is about valuing a stock. I'm not sharing this with you because necessarily this specific stock, but it reminded me of something I want to make sure that you understand when it comes to trading stocks and options and the values of companies. Here we see Captain Sarge asked a question about what I thought about the value of Dollar General. Do I think it's undervalued? My response was, I do believe it is undervalued based on its current fundamentals. So if you solely based on that, I'd say it's undervalued because I do think it is undervalued. But here's where you gotta be careful. Just because the company is undervalued, does it make it a good investment? Well, it depends. If the fundamentals are holding up, then absolutely. I think it's a good deal. Let's do it. But you do want to look at what's happening to the fundamentals. And that's why I wanted to share my response with you here. Personally, I do believe DG is undervalued. However, there are a couple things I don't like about DG fundamentally. I don't like how much their adjusted operating earnings, free cash flow, and EBIT has dropped over the past couple of years. However, the sales are holding up, so maybe they're just going through a phase. And the point here is, just because a company is undervalued doesn't necessarily make it a good investment or a good company to sell options in. Now, I'm not saying I wouldn't sell options against Dollar General because I would at some price. But just because something is undervalued doesn't necessarily mean it's just a great deal. You should jump on it right away. You want to make sure you understand what's going on with the company fundamentally. But right now, Dollar General is really beaten down as you see here. Over the past couple of years, its value has dropped 72%. So it is really down right now. So it is a company I would consider selling some put options in, but I just be very careful with it because some of the fundamentals, they look a little fishy. So I think the point here is just make sure you understand what's going on with the fundamentals. Just because the company is undervalued doesn't by itself mean it's a good investment or a good stock to sell options in. Make sure you understand and are comfortable with what's going on with the company. I thought it was a great question that Sarge asked because it shows that they're thinking about just because it's undervalued, is it a good investment? Well, you have to decide that for yourself. Here's another very common question I get asked about position sizing. As most of you know, my personal rule is I want to have at most around 5% at risk in any one position in my larger account, but initially I want to have 2 to 3% at risk. That leaves me another 2 to 3% to help repair the position if it goes against me. So how do you calculate that overall 5%? Here's how I calculate that position size. Let's say, for example, my Comcast position here. So I've sold 9 contracts of the April $35 cash share put options. So I've done the math for you here. It's the $35 strike price times the 900 potential shares I could possibly be assigned. Now my goal is to not be assigned here, but that could possibly happen. That dollar amount is $31,500. That's what I have at risk right now in Comcast if it went to zero. So how much does that compare to my overall portfolio? Well, let's say I had a $250,000 portfolio. If I do the math, $31,500 divided by $250,000, see Comcast will be making up about 12.6% of my portfolio. So personally for me, in this larger portfolio, that wouldn't work. So obviously my portfolio is a lot bigger than this because my rule is to keep a position under 5%. That's how you calculate it. How much do you have at risk if everything was assigned to you compared to your overall portfolio? That gives you the amount you have at risk in each position. And let me share one more for you because when it gets a little more complicated is when the position's gone against you. So I had my initial 2 to 3% position size. The position went against me. I allowed the put options to be assigned to me. I turned it into a covered call. Then I sold some additional cash secure put options to help fund rolling my covered call up and down. Here's a position where that happened with Tyson, which is ticker symbol TSN. Notice that we're short 4 of the $57.5 put options, but we're also short 6 of the $57.5 covered calls. As you see here, it says my average price was $54.88, but I know I actually was assigned this at $57.50. The reason why my broker says the average price is lower is because they're taking into consideration the amount of premium we received for the put options we sold that were assigned to us. But if we simply do the math here, we've sold 4 of the $57.5 put options. We also bought 600 shares worth of Tyson at $57.5. So basically we have 1,000 shares at risk. 6 here that we already own and 4 more if these were assigned to us. That's 10 contracts times 100 shares per contract. That's 1,000 shares worth. The strike price is $57.5. So I have $57,500 at risk right now in Tyson. And if we had a $500,000 portfolio, as you see here, that means this Tyson position would amount to 11.5% of my overall portfolio. Now we're down to the last question I'll answer for you. It's one I get quite often. So I thought it was a good one, a little more complicated, so I saved it for the end here. But this is a really good question, especially for those of you that are learning technical analysis. And it came from a video I did on moving averages. So thank you, Fabio, for the question. I'm sorry if that's a first name or partial of a name, but thank you very much for your question. It was a really good question, so I thought I'd share the answer with all of you here. The general gist of the question is, at what point can you say the moving averages are serving as support or resistance for a stock? How many times does it need to test it or touch it before you say, you know what, that moving average is serving as support for a stock? Because sometimes moving averages don't. So you want to wait for them to start serving as support or resistance before you start using them. Let's just talk through a couple examples here to help answer this question. So here you see a daily chart of CME. And notice how many times it's came down, approached this green 50 moving average, and it served as support for it, or nearly served as support for it, okay? So we have 1, 2, I'm gonna say 3, 4, 5, 6, and then it broke through. So we're kind of in the, uh-oh here, it's not working, maybe this is not gonna be resistance. But then pushed back through, so we're back to our normal routine of it's serving as support and serves as support for it again here. So overall, I'd feel comfortable saying that CME, it tends to respect this green 50 moving average. So if it came back down here around this green 50 moving average and everything else technically was looking good, then I expect it to probably find support at the moving average. Just remember, it doesn't always do it. Nothing is 100% certain. Just want to keep in mind what will happen if it pushes through that moving average. Now I'll switch over to the weekly chart of CME. Let's say you do longer time frame trades. You want to use a longer time frame chart. Well, notice again, this green 50 moving average, it tends to serve as resistance forward in here, resistance in here, and then support, and then kind of so-so, but the red 200 moving average did serve as support in here, kind of served as support back in here. Now it's broken up higher. If it came back down and was around other support, I'd say, well, odds are it might find support around this green 50 moving average. Do notice it's not exact. The daily chart was a little more exact. This longer time frame weekly chart, it's not as exact. Just kind of look at what's happened with it. If it never honors the moving averages, then absolutely don't use them. But if it has a history of honoring the moving averages, I'd definitely consider it until it breaks that history. We'll look at one more example here with Dollar General. So notice what's happened. It's tested this red 200 moving average up here, and then the green 50 moving average multiple times. And yes, it has pushed through several times, but overall, this green 50 moving average has held as resistance. Now what's interesting is if I zoom in here, some really big green bullish candles here. So is that run over? Well, maybe. But we do see that it did push through a couple times, so it'll be interesting to see what happens as it gets closer to this red 200 moving average. When I switch over to this weekly chart, I want you to notice something here. Notice that the green 50 moving average tends to serve as support for Dollar General many times, but every so often, it pushes through and it tests this red 200 moving average. So it did it here, here, and here. So overall, lots of times when it tested the green 50 moving average, but if I was going to trade Dollar General and it was back in this bullish uptrend, I'd say I expected to find support here, but it wouldn't surprise me if every once in a while it came down here to this red 200 moving average. Now we're on the bad side of Dollar General, it's been going down. So now this green 50 moving average has been serving as resistance for it. So again, as it approaches the green 50 moving average, I'd say, well, odds are it'll probably find resistance until it breaks that resistance. So I just like to look at the history, then always keep in the back of your mind that at some point, the trend is probably going to break. And one final little tip here before I close this video out, where I got to answer a bunch of y'all's great questions, is in a situation like this, I am looking at these moving averages, but I'm also looking at a trend line that I have drawn. Notice that we have this resistance line right in here. I would not feel comfortable going fully long in Dollar General until it broke this diagonal line, and preferably broke this diagonal downtrending line, as well as found some nice horizontal support. Now, it wouldn't mean I would never sell a cash secure put option in it, but it'd be pretty far out of the money if I did. So moving averages are great. Just remember they don't work 100% of the time, but please learn moving averages. They will help improve the amount of your dollar wins as well as the percentage of your wins. If you like the format of this video where I answer your questions, please give it a big thumbs up. I keep track of that stuff, so help me know that you want me to do more of these type of videos or do them more often. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. One of the strategies I mentioned in this video was a risk reversal. They can be a very low risk and potentially very high reward type of option trade if done properly. If you want to see how I use risk reversals to put nice cash into my pocket, check out the video, the link above and the description below, entitled Very Low Risk, Very High Reward Option Trading Strategy. Until next time, happy investing, and we'll see you again soon.